Hi, this is Carl Meyer coming to you today from Houston, Texas. Today let's talk about Amazon. Amazon's in the news because their employees aren't getting paid as much. How's that happen? Amazon's stock price has been going down and it's fallen below the strike price on the options, the stock options that the employees have been getting recently. So the recent stock options are now what they call underwater. They are worth zero at this point until the stock goes back up. Long-term trend is a higher cost of capital, higher interest rates. That necessarily pushes stocks down, stock prices down for the same level of earnings. So that's not good news for the employees of Amazon for their stock options, and that could mean challenges for companies like Amazon that depend on those stock options as a way of compensating their employees. Do they have to raise the cash payments they're paying to employees in order to keep their people? Good question. We'll see what they do. These long-term trends are ones that I cover in my book, Surfing Economic Chaos, which comes out on March 30th. Look for that. These same trends impact smaller companies. You don't have to be a public company. You don't have to have a stock option plan to be impacted by these trends. The shrinking labor markets, the inflation, the higher interest rates, and other impacts are still out there. So just like Amazon's got to reevaluate some of their practices, their labor practices, probably less so for capital, but for smaller companies, you should be thinking about, how does this impact me on the labor side, on the capital side? Many of your operations could be impacted by this too. Check out my book, and I'll have more for you next time.